Hi, this is Keith Schneider, CEO of MarketGauge.com, and this is May 24th edition of Market Outlook. So, quiet week if you're looking at U.S. equities, a little bit of fireworks overseas in Asia, which we'll get to. If you're not receiving this free weekly, please sign up by going to www.marketgauge.com and you get the free text version and my video commentary as well. So, let's take a look at what's happening in the U.S. equities market. Well, first of all, very quiet week um, this week, even though Yellen spoke, so that was um, unusual. Usually you would expect some more fireworks. A couple of noteworthy things. You can see that the top of this channel comes in just around 216 or so. However, this breakout from this sideways consolidation and relatively narrow range. In fact, in terms of the Dow, it's probably the narrowest 6 month range in about 100 years. At least that's something, some statistic that I did see on the internet, and I do believe it's probably correct. So this sideways action just can't seem to get out of its way. It just reluctantly makes new highs and then consolidates. Now, what is interesting is a couple of things. Number one, this extreme sideways compression at the highs. So we made a new high rather than a breakout with some velocity to the upside. Look what's happened here. Lots of sideways action on declining volume. That is generally not what you want to see on a breakout after such a long period of time. But nonetheless, the market's going to tell us which way to go. The key point here is under this cyan line, which is the 10-day moving average and coincides with the breakout day to new highs. So you have to watch 211.80 level or 212 level. That's a critical support level for this market. On the other hand, a breakout after this inside day might get some follow through, which would be certainly what the market does not expect. Let's take a look at IWM. This one is lagging the most out of all the indices, and also the one that we had the highest degree of promise for, considering, let's we take a look, about a year and a half of sideways action. And again, we broke out, couldn't really get any momentum going, and on Friday we basically closed at some converging moving averages at the 124 level. So you definitely want to watch IWM. The fact that it cannot get any real forward motion here is a point of concern for U.S. equities as well. Um, that is definitely noteworthy. On the other hand, this does tend to move quickly and rapidly, and it's possible certainly it can regain its its leadership position for this year. Um, so let's take a look at some of the market internals, the indicators on the S&P and the broad indices. Interesting, the McClellan oscillator, which looks out over the next couple of weeks. We had a couple of buy signals, very relatively small muted response. And what is interesting to note, as we're making new highs, the breadth you can see here made a new high. Down here up on the new high, breadth was not as good on the McClellan. Again, a new high, breadth failed again. um, Barely eked out a new high, and much lower participation, and the same thing on the new highs here. So low participation. So on the shorter term, our looking out over a couple days to a week or so, the advanced decline, as you can see, um, this really clarifies that. You can see how we're declining as the market is struggling to make new highs. and volume 2 relatively lackluster. So if we go back to the chart, you can see that this low volume here, right, continued low volume um, during the last week or so on this new high is definitely a, something to take notice of. So you can see on the S&P really dropped off here all week, and relative to the 50-day moving average of volume, you can see we've really been trailing off pretty much throughout the year, although we've had the spikes, generally speaking, on the down moves. Okay, so we went through the market internals, not a lot of good participation. Another cause of concern is looking at short-term versus 3-month volatility on the options on the S&P. And as you can see, we got up to 1.24. We pointed that out last week, which is extremely rich. Now, in bull markets, sometimes it works itself off by going sideways or relatively muted action. This is what did occur. But meanwhile, we're still sitting at a relatively high level. Um, these are the bands here. We're at the upper end of the band. The moving average not quite breached with confirmation as of Friday. We did try to get through that MA earlier in the week, but really just small sideways to down small. So sentiment still rather rich. And when you look at the absolute levels in the VIX, you can see we hit the bottom end of the Bollinger Band on 3 days this week, closed below it, and on Friday just eked out a small close above the line. So um, again, sentiment pretty frothy at the moment. Um, Obviously, you can't argue with the overall longer term trend. Momentum and directionality relatively weak to flat, even though we go marginally to the upside. But take a look at this weekly volatility. Again, cause from cause for concern because sentiment is running rich, and interestingly enough, it's also going to be confirmed by another set of analysis that I do in a moment as well. So let's go to looking at a couple of other things here. Let's look at global stocks. Well, again, on a longer term basis, you can't argue with the S&P 500 and the leading U.S. indices. Obviously, still on a weekly trend, very, very bullish. We've got the short-term 15-week moving average, the 65-week, and the 200 all stacked and sloped and relatively steady. So trend, you can say not much momentum to the upside over the last couple months, but still intact. Now compare this to a couple of other markets. Look at Asia. This is a regional index without Japan. And as you can see, the Asian markets are really picking up. And now that's very, very interesting, especially considering the fallout last week when one of the wealthiest Chinese entrepreneurs lost 14 billion overnight when his solar company that makes thin wafers basically got cut in half. $14 billion loss, cut his net worth in half. Not so bad to be only left with, I don't know, 15 or 16 billion. But nonetheless, the Asian markets really shrugged that off. Now, it's pretty unusual to have a piece of news like that and then have the markets up as much as they are, and basically really just shake off that news. So the Asian market, that region without Japan, closed up over 1% on Friday. And you can see there's a lot more momentum gravitating to the Asian markets here. Also to note, volume is coming in. So where the U.S. volume in the key indices dropping off, money definitely moving to overseas despite those crazy moves in those thin companies. Let's take a look at FXI. And just to get a perspective here, although it hasn't taken out its highs from 2006, 2007, this huge basing action and this potential flag action here and this accelerated move to the upside in China with some decent volume patterns as well is interesting to note. So money definitely flowing into the Asian markets here. Okay, another way to look at risk on, risk off throughout the world is to look at the safety of U.S. bonds and how emerging market debt, sovereign market debt, high yield debt, corporate debt, and junk debt are performing relative to bonds. And that gives you a pretty good indication of risk on, risk off. And here you can see number one, let's take a look at emerging market sovereign debt. As you can see, as the emerging market debt has basically remained stable as U.S. bonds have sold off, the ratio has improved. So that's a positive. Risk on, still in play. And again, debt holders are much more savvy about the markets, generally speaking, than equity players. So, taking a look at just general junk debt, same type of scenario. You can see this red line above the green line, which is a moving average, that the weekly basis has definitely improved. Sideways action in the junk debt group or ETF, while the U.S. bonds have sold off. Let's take a look at another market as well. You can look at here's emerging market debt, EMB, another way to look at it. And again, pretty much the same picture. Very stable pricing in emerging market. On the other hand, the pressure in U.S. bonds apparent as the ratio has improved in favor of the higher yield debt, which again indicates global players have a risk on appetite. All right, one last thing to look at here is looking at some key weekly ratios in some of the sectors. As you can see here, IYT, transportation, really fell apart again this week on a relative basis. Again, as we eked out new highs in the S&P, the transportation index has sold off. So another cause for concern. So sentiment pretty frothy, market internals a little bit mixed to lackluster. The overall trend in U.S. equities positive, but with limited momentum, and it seems like money is flowing overseas, especially to Asia. And in spite of all that negative news regarding that solar play in China, markets in Asia shrugged that off and actually had a roaring day on Friday. China FXI closed up extremely well. So again, taking a look at FXI, China relative to the US, you can see China up nicely. Last was 51.45. I think it was up almost 3% on Friday, while U.S. markets were muted, mostly flat. But again, take a look down here. You can see the confirmation where we've moved above the green, the weekly moving average of the ratio, moving out pretty strongly, and also breaking out on a relative basis. China is broken out over a multi-year pattern going back almost 2 years, that the ratio of Chinese securities and U.S. S&P 500 is actually improving in favor of Asia and China. This one specifically is China. So again, a lot more room to the upside in the Chinese market. Back in 2008, ratio was quite a bit higher, almost double from where we are. But nonetheless, we are on a positive move to the upside of Asian markets relative to the US. Okay, hope that helps, gives an overall perspective. See you next week, and good luck with your trading, and bye for now.